even professional investors are underestimating the concentration risk they're taking in the S&P 500. It's been drummed into us for the past 50 years that the S&P 500 is a broadly based index representative of the whole economy in the United States. If you don't have an opinion and you just want to ride the wave of long-term stock price performance, just own the S&P and don't think about it, and that's the low-risk alternative for investing. As recently as 10 years ago, that was probably even true. Top 10 names were like 15% of the index, good diversification across industries. But you look at what the S&P 500 has become because of a handful of extremely successful companies. It's basically become a concentrated technology mega cap growth fund. Morningstar changed its definitions of value and growth to avoid calling the S&P 500 a growth fund. The S&P has pulled financial technology names out of the tech sector. They've pulled information technology names like Alphabet and Meta out of technology, because if you hadn't done that, tech would now be like 45% of the index. Living in the United States, we've had a luxury that most of the world hasn't had, that just says if you buy our local economy, it's a pretty well diversified basket. People who live in South Africa or Australia, the investment advisors would never be telling them just invest in the local economy because it's enormously tilted toward metals and mining. Just as we've all gotten used to the idea that index investing in the S&P 500 is the safest way to invest, it's actually become the most unsafe index out there. You think about something like the Russell Value, that's an alternative index, that 10 years ago was a pretty slow growth index. Today, the Russell Value has 870 of the 1,000 largest companies in it because the really big companies have crowded everything else out. And growth names like Amazon, Alphabet, Meta, Coinbase, those are all in the Russell Value now. The Russell Value today looks a lot like the S&P 500 did 10 years ago in diversification, in growth characteristics. The biggest risk out there for individuals and advisors in our industry is keeping everything we do tethered to an index that we want to believe is diversified, but really isn't. It's imperative for advisors in our industry to be explaining this risk to their customers and bringing back the indexes we measure ourselves against to things that are more tethered to our investors' financial needs. Whether or not NVIDIA triples in size from here over the next couple decades really has very little to do with whether the average person's savings are going to help meet their retirement needs or help put their kids through college. Tying everything we think about to the S&P 500 is just becoming more and more divorced from our investors' needs. To me, that's a big risk.